So welcome everybody to the brand new Patriot Report. My name is Bobby Bones, and I welcome you here into Liberty One Studios here in beautiful Greenville, South Carolina. This is where we discuss freedom, liberty, and sound economic policies. I really appreciate everyone for joining. Listen, we have a lot to get into, so I want to get right into it. Today was another Fed day. And as expected, they caught another quarter point from the Fed fund rate. So now the Fed's fund rate is 3.75% to 4% funds rate. Now the official inflation rate was last clocked in right at 3%. But if you have been following my program and you know that the Fed is lying when they put out the inflation rate, that the inflation rate is actually bogus, the numbers that they put out. It's ridiculous how they count inflation to begin with. The real rate of inflation, if counted correctly, is somewhere around 5 to 6%. So we are now clearly in negative interest rate territory, meaning that the government is basically paying people to borrow money. And of course, this is the opposite of what we need to help bring down prices and reshore manufacturing. Also, hang out until the end of the video, because later in the video, I'm going to show you a real experience that happened to me. I stumbled upon something yesterday that was in a closet. And I'm going to show you exactly how much the Federal Reserve has destroyed your purchasing power, okay? So stay tuned for that. Also, please hit the notification button. This way, you know the next time I upload a video. And please hit the like button and comment. I don't care what you comment. Just please leave a comment, because that's going to help the algorithm. It tells YouTube that there's engagement, and they're going to push the videos out more. So I appreciate you. I love you. And I hope that you're having a good day. Also, last thing, if you're even 1% more smarter, subscribe. Okay? It's a fair trade, right? It doesn't cost you anything to subscribe. And if you're learning something new, that's a value to you. So please do that. I appreciate you. So let's get back into it. So it's savings and production and producing goods and services that build a strong economy, not debt and consumption. The Fed and most economists have this backwards because they're all Keynesians, right? I joke all the time that in order to be an economist on TV, right, you have to basically fail basic economics. But I digress. So the Fed also came out and stated that they are officially ending their quantitative tightening policies. Now, for anyone who has been following me for a long time knows that I've been saying for years that the Fed will reverse long before they ever take all of that debt off of their balance sheets. And the reason for that is because I understood that once the Fed started monetizing the debt, that we would never be able to reverse it. The balance sheets right now at the Fed is right at $6.7 trillion. So the Fed didn't even come close to removing all the debt off its balance sheets. And just so my listeners understand, especially my brand new subscribers and people just watching me for the first time, you, the taxpayers, are on the hook for that $6.7 trillion. Okay, just so you know. So we don't only have $38 trillion in debt, you also now have to add another $6.7 trillion on top, not including the new debt that they're going to monetize, right? That doesn't resemble a strong economy. Strong economies pay down debt, build savings, and increase production. Right now, what we're doing is the opposite of that. And what I want to do is give a little history, because I think it's very important to understand all of this stuff. So back around 2009, the Fed started its QE program and took on about $1 trillion in debt, basically monetizing the debt, which is completely unconstitutional for those wondering, and goes directly against Fed policies. Actually, the only way Congress was going to vote to allow the Federal Reserve to even be created back in 1913 was to strictly prohibit the Fed from monetizing the debt. But just like everything else in this country, the government and the Fed does whatever the hell it wants. So what happened is, after the '08 financial crisis, the Fed under Bernanke said it would be one and done with QE. And I stated that that's a bunch of BS. That we will have more QE programs than Rocky movies. Right? And now we're going on our 5th QE program. And I said back then that the Fed can check in anytime it likes, but it can never leave, because now we're officially in a monetary roach motel, right? And here's the thing. Back then, Bernanke was testifying in front of Congress. And when he was asked about QE1, if he would acknowledge that QE was monetizing the debt. And he stated that America is not a banana republic, and that this was only a temporary measure, and I was saying that that's all BS. Now, we need to put this all into perspective, because when talking about trillions of dollars, people can get lost. Okay, so back then, the Fed monetized almost $1 trillion in debt. Well, fast forward to today, 16 years later, right? And now we are monetizing, check this out, 670% more debt than we took on back then. So we are not only a banana republic, but we don't even have the bananas. And if you want bananas today, you'll have to pay up way more for the same banana. And not only have to pay up more because of the inflation, but now you have tariffs and other taxes put on top of that banana, right? But more importantly, Bernanke stated at that hearing in Congress that the key difference between a banana republic and the U.S. is that when a banana republic buys their own government bonds, they keep them. Well, what the hell is this, right? We're 16 years later, we're still holding on to those government bonds. And we're not only holding on to them, we bought more, right? And he stated because of the '08 crisis that this was only a temporary measure, and that this was not a permanent expansion of the money supply and debt. And just so that people understand who are new to this channel and don't understand what creates inflation, inflation, by definition, if you bought a Webster's dictionary in the 1970s, the original definition is an expansion of the money supply and credit, right? And it was '08 where the Federal Reserve really started revving up the printing presses and expanding the amount of paper that it had and that it was holding, and doling out to the economy. You know, they were raining money all over the place, bailing out the banks and the housing market, right? So here's the thing. You know, we've been holding all of these bonds and buying more bonds for over a decade and a half. So either Bernanke lied or he was clearly wrong. So anyway, at the time, I said that it was all BS and that Bernanke could claim that it was temporary, but I knew that it was impossible for the Fed to reverse course once we took these actions. And now, fast forward here to 2025, Powell came out today and said that he's reversing course. We're no longer going to do quantitative tightening, and basically is telling the world, hey, we're going to start revving up the presses again, right? And I really think that the Fed should come out and officially admit that, yes, now we are going to continue monetizing the debt, and yes, we are now officially a banana republic. But here's the thing. It doesn't matter if they officially come out and tell the truth, because the truth is that the world can see it for themselves. Foreign central banks see it firsthand. That is why they are foregoing 4% on U.S. Treasury bills and collecting that interest, right? Instead, what they're doing is they would rather buy gold that gives them no interest. Now think about that, right? So they have such little confidence in our central bank to curtail inflation, that they are not going to take the 4% interest and hold gold. And the reason for that is because what they don't want to happen is for the Fed to pay them back with bills that are worth nothing, right? See, they're not afraid that they're not going to get their paper, right? What central banks are afraid of is that when they get their paper, it's worthless, right? So that's another way that governments default, right? And when you hear politicians saying, oh, we always pay our bills, that is a complete lie, right? Because if we always paid our bills, right, then we wouldn't have exploding deficits, right? And we'd be able to not have to destroy the currency in order to pay for deficits, right? And foreign central banks see this, and they don't want to get paid back a bunch of paper that's worthless, so they're buying gold. And that's what I have been trying to tell my listeners for years, back as far back as when it was $250 an ounce. And the thing to really hammer home is that what the central foreign banks are really afraid of is the Fed printing up a bunch of worthless paper, paying them back with nothing. That is why gold has been leading the charge in the de-dollarization trade, and why gold blew past $4,000 an ounce. I have been telling my friends and listeners to buy gold back when it was $250 an ounce. And if they cannot, and now here's the thing, if you're watching this and you cannot afford $4,000 gold, then you need to buy the next best thing, which is silver at $48 an ounce. Also, another trade that nobody out there has been talking about is platinum. Platinum has nearly doubled this year alone. And I was probably the only guy out there talking about platinum because I understood that platinum was completely being overlooked by investors, and it still is. And so the price today is around $1,600, which is actually very cheap for platinum per ounce. And here's another thing that is telling the Fed to stop cutting rates, right, and to actually fix the dollar, because not only is gold screaming and silver and platinum screaming that the Fed is taking the wrong direction, but also industrial metals like copper and aluminum are hitting 52-week highs today, right? 6 months ago, now think about this. 6 months ago, Trump was complaining that it cost 3 cents to make a penny. Well, soon, if the Fed keeps going the way that it's going to cost 5 cents. Which is why I am also invested in industrial metals as well, and why I have been encouraging my listeners to also jump in before the inflation train leaves the station. Because what Powell just did was pour more gas on the inflation fires that they created. And this will only speed up the de-dollarization trade even more. So right now, let's look at the futures and precious metals. Gold is pointing slightly higher. So is silver, and platinum right now is basically flat. Look into gold and silver mining stocks. This is another play that I've been encouraging my listeners to keep track of. If you had, when I first started this program about 10 months ago, if you had bought any one of these stocks I'm going to mention right now, the worst performing asset of the ones I picked is doing better than the Dow. Okay, so my worst performing asset is up 40%. My best performing asset is over 200% better than the Dow. Okay, just so my listeners understand, okay, all of these gold mining stocks were the best performers on the Dow. And although we've had a slight pullback recently, and I'm going to go into that in a moment, why that was, you were getting in still in basement levels, because the thing about it is you want to get into these trades before everybody starts talking about them, right? You want to be the first one in, right? You want it's like going to a party and getting the best seat at the party, right? So you want to get in while the getting is good, right? Because once everybody figures out that this is the trade to take, because the dollar is running away with inflation, it'll be too late. It'll be too expensive for you to jump in. So anyway, look in to the gold and silver miners. The GDX is pointing up. The GDXJ is flat today. Pan American Silver is slightly down, but is a real bargain at $35.09 a share, especially when silver is at $48 an ounce. So think about it. You could buy Pan American Silver. It's a real company, has real earnings, right? Generates real profits, right? And it's a discount at $35.09, right? So this is a play you've got to jump into. Also, Barrick Gold. Now, what's funny about Barrick Gold is last year, I was watching CNBC and Fox Business News, and there were these analysts going around, these Wall Street analysts. And they were saying, sell Barrick Gold, sell Barrick Gold, sell Barrick Gold. And I was saying, that's a stupid play. You need to buy Barrick Gold, because I understood that the policies that the federal government and that the Fed was going to make was going to hurt the dollar even more. And since then, the dollar has lost plus 10% of its value. But more importantly, Barrick Gold was up like 45% this year, right? Since the so-called know-it-all analyst told you don't buy it, right? Barrick Gold today is pointing slightly higher. So, look, the precious metals is a mixed bag right now. All of these stocks have had some of the best earnings in the Dow this year. And I believe that earnings will be even better when the next report comes out. Now, here's the thing you have to understand about companies is actual supply and demand. Let's put it like this. The demand was so big over the past quarter for the mining companies that the mining companies couldn't even produce enough metal to deliver to their customers. They had so much demand, right? And like I said, these were some of the most high profitable companies on the whole Dow, right? This wasn't like where you see tech stocks and AI stocks like NVIDIA, right? NVIDIA, right now, what they're doing is to bolster their stock is they'll give, let's say, another company $10 million, let's say $1 billion, right? And then what that company does is take that $1 billion to go buy their own product. So they're buying their own product just to create fake demand. And they've done this now 7 or 8 times. And the average investor doesn't see that bubble, right? That is bubble mania. That's what happened during the dot-com, right? With Intel and other companies. They were going out there funding side little companies who then would turn around with that same money to buy their own product, right? That's right now what's happening in AI, and NVIDIA is leading the charge. Here in the mining stocks, you have real companies buying real metal, right? They are beating down the door, and foreign central banks are beating down the door to get this product. This is not trying to front run sales. This is actual sales and actual production of product. And here's the thing. Demand isn't going away. And by the time, and here's the thing to understand. So let's say you didn't get an order, right? Let's say you tried to get 1,000 ounces of silver, right? And they're mining the silver, and maybe they were able to give you 850 ounces, right? Because they couldn't give you the full 1,000, right? They couldn't get it out fast enough. Well, by the time the company receives that extra 150 ounces of silver, it's going to be up, right? So they bought at a cheaper price. They're getting a good deal. It's also good for the mining company, because what happens is it spurs more demand, because when a company who's buying the silver and gold, right, they're getting better returns. What are they going to do? They're going to buy more silver and gold. That's how the train leaves the station on investments like this. And so, yes, by the time they extract the metals out of the earth, the metal will be worth much more. So it's a good thing for the investors and an incredible purchase to invest in. See, here's what I try to explain to my listeners and viewers. Leaving your money in the bank and collecting 4% on your bills, while at the same time the Fed is destroying 6% of your purchasing power, is a terrible move. So go protect yourself today and take advantage of the brief discounts taking place in the precious metals market. And, you know, here's the thing. I'm going to give you, I want to share a real life example of just how much the Fed has destroyed our purchasing power over the past couple of decades. So I thought that this was really interesting. This is my story I wanted to share with you guys, just to kind of put it into perspective, how I view things, right? When I buy a home or a car or any asset, a stock, the Dow, how I price things, I price them in gold, because gold is real money, right? So anyway, check out this story. So I was cleaning out my closet, and there was an old box there and in this box, I used to hold some important papers, right? And in the box was a check that I wrote my uncle for $6,000. Now, he never cashed the check. I never gave it to him, because now thinking back, I actually went to the bank, pulled out the cash and gave it to him, right? Now, the thing was, this check was written in 2003, right? So it got me thinking, and I was interested to see in how much purchasing power that check has lost since I wrote it, right? So check this out. Back in 2003, gold was roughly $350 per ounce, right? Today, gold is right at $4,000 per ounce. So, doing the rough math, back then, I could have bought 11 ounces of gold. Today, that same check for $6,000 can only buy you 1.5 ounces of gold. So think about this. In 2003, if I went down to go buy some gold, I could have bought 11 ounces. Today, that same check can only buy 1.25 ounces of gold. So think about it. What has changed? The gold is still the same, right? The properties of the gold never changes, right? That's the beautiful thing about gold. It doesn't rot, right? It doesn't go bad. It doesn't spoil. It doesn't, the properties of it doesn't change, right? It's here forever, right? It's the dollars that changed, right? So when you're valuing assets, you need to value them in gold to see if your investments are keeping up with the price of gold, because gold is real money. Now, look at it from this perspective. Had I bought 11 ounces of gold in 2003 with that check, the $6,000 today in gold would be worth $44,000, okay? So this is a real example of why everyone listening to my program needs to protect themselves, and why programs like this is so important, and why you need to share my program with your loved ones, your friends, right? Because, you know, if we're being honest, you're not going to get this perspective on CNBC, Bloomberg TV. Actually, 99% of podcasters and so-called independent media, I mean, they'll tell you, like, they'll run a commercial to buy gold, but they don't know why to buy gold, right? They don't understand the mechanics of why people should protect themselves, right? They don't understand interest rates, right? Because a lot of the same people who tell you to buy gold also support interest rates going lower, right? During an inflation fire, which is the opposite of what we need, right? We need savings, right? We need to bring back manufacturing and jobs, right? And you're not going to do that by encouraging people to take on more debt. And also, you know, here's the thing that I ask all of my listeners and viewers. If you are even 1% smarter, right? You educated yourself a little bit more watching this video, please subscribe to the channel, right? It doesn't cost anything. Of course, hit the notification button and like it, right? Also, keep an eye out for future videos coming. I actually did 2 videos prior to cutting this one, but what Powell did was so important that I shelved those 2 videos and I'm putting this one out first. All right? And my next video is going to be on Mamdani, the New York City frontrunner, mayor, on freezing the rent, right? And why that is really destructive to the economy of New York City. So please keep your eye out for that. So anyway, I am thankful for you, Patriots. I promise to always stand up for liberty, freedom, and of course, sound economic policy. Stay strong, and I'll see you on the next one. Take care.